Wall Street closes mixed as equities contend with the spike in the 10-year bond yield, which is at its highest level since October of 2007. Stocks in the Asia-Pacific open lower, while the GIFT Nifty is implying a gap-down start for the Indian market. Oil prices tumbled to a three-week low. Brent crude trades at around $90 a barrel mark amid profit booking after the recent rally as a stronger dollar weighs on prices. India's fiscal deficit in the first 5 months of FY24 stands at 6.43 lakh crores. This is 36% of the full-year target. The government says net tax collected stands at around 34.5% of the budget estimate. And Anil Agarwal's Vedanta plans a mega restructuring, looks to demerge into 6 independent companies, with shareholders getting 1 share in each of the new listed companies for every share in the currently listed entity. Credit ratings agency S&P downgrades the metal giant and puts it on credit watch. TVS and Hero Motors September sales beat estimates in a strong show. Aisha's monthly sales fall but still meet expectations. M&M's SUV sales remain robust, although tractors slow down, while Maruti sees low single-digit growth in September. The market leader's half-yearly sales topped 1 million for the first time. Good morning and welcome to Power Breakfast. I'm Pavitra Parekh. Those are the top headlines that we have for you. We're coming out of a long weekend, so there's clearly lots to catch up on and lots to talk about. As always, let's take a look at what's happening across the global markets, because the handover from the US was a little bit negative, and on the back of that, you have all of the Asian markets trading with cuts this morning. By the way, 2 of them are shut today, so the Shanghai and Korean markets are shut for trade, so we're not getting any rates from there. But the rates that we do have, the Hong Kong market is seeing sharp cuts, over 400 points gone over there, so 2.6% in the red. This is clearly the worst performer this morning. In fact, even yesterday it was not looking so good. The Nikkei market is also seeing cuts of 1.4%. So across the board, you know, the rates that we are getting from Asia don't look encouraging at all. The Taiwanese index also seeing just a little bit of red right now, and Straits also is around 0.7% in the red. So whichever Asian market you look at, which is trading, is seeing some cuts this morning. The GIFT Nifty will also come up for you, and on the back of all of these cues, it is implying a gap down start for our own markets. 127 points lower is where we're at on, you know, where the implied open could be for the GIFT Nifty. With that, let's also move on and talk about the US markets, because like I was pointing out, Wall Street ended Monday's trading session quite mixed after key indices came off their worst month of the year. So the Dow closed with a loss of around 74 points. The S&P was quite flat at the end of the trading session, and the tech-heavy Nasdaq managed to see a little bit of green. It ended around 88 points in the red, like you can see. Now, the market's mixed reaction comes even as US legislators managed to seal a short-term agreement that staved off a government shutdown. That is important to track. And, you know, another important factor that we're looking at from the US markets is what's happening with the money market. The 10-year treasury yield surged to its highest levels since 2007, topping 4.7%. So that is the key data point to track as well. Those are the rates on your screen. But with that, let's also bring you some important opinion. This comes in from Mohammed El-Arian, Chief Economic Advisor at Allianz, as he talks about the US averting a government shutdown and the impact that it could have on the markets. Listen in.
Government failures and market failures. And when the two come together, then externalities do not get priced into the system. So markets do not function as well. Look at our supply chains as an example for that. You need cooperative solutions to common problems. So yes, there's a lot that the private sector is doing and will continue doing, but there's also a lot of what the public sector needs to do. And it's not just government. I think the Fed has a role to play in this in terms of its monetary framework and inflation target. It extends beyond. We have to embrace the notion, which we haven't done yet sufficiently, that we're no longer in a world where it's insufficient demand and you can just throw money at it. That's the old world. The new world is inflexible supply, and you've got to work hard to fix it.
All right, that is the word coming in from Mohammed El-Arian. Let's also quickly take a look at what's happening across the European markets. Of course, these are rates that we got for yesterday, and it was pretty mixed across the European markets as well. So if we can get some of the rates up for you, the CAC is, you know, down almost 1%, 0.9% over there. The DAX, that is a German index for today, I think it is shut for trade, so we're not getting any rates from there. But the CAC index is seeing some cuts right now, down around 0.9%. So we'll see how this opens up today. But this is the rate that we got for yesterday. Let's also focus on the commodity space now. Crude oil prices, that is the key tracker, and those fell around 2% to a 3-week low after the strong rally that we've seen in September. Remember, we saw that massive rally in crude oil prices, but we've now seen them coming off those multi-year highs to trade around the $90 a barrel mark amid some profit booking. Now, in terms of what we should track for the crude oil prices, there is a very important OPEC meet lined up. This is tomorrow, so of course we'll bring you details from that. And higher supplies are expected from Turkey, while top producer Saudi Arabia is also expected to ease its output cut. That is the crude price right now, currently around $90 a barrel. And that's pretty much everything we're looking at globally. Let's now talk about how all of these overnight cues impact our own markets, as well as all of the individual stocks that you should watch for in today's trading session. We have our research team here with the trade setup. Nigel, Vivek and Surbhi are all with me now to really prep you up for this trading session. Guys, a very good morning to all of you. And Vivek, let me come across to you first. We were just going through the global setup, which doesn't look so positive. And, you know, it is looking like we will get a start, which is deep in the red. But take us through everything that we should track from a domestic standpoint.
Yeah, good morning. And you're absolutely right. You know, the overnight or, you know, the kind of handover that we've gone over the extended weekend has been quite muted, despite the fact that, you know, the U.S. government shutdown has been averted. Most of the U.S. indices have closed in the red. Now, the other thing to watch out for are oil prices, and you know, that's going to act as a bit of a soften as far as the blow that we're going to receive today morning. Now, crude oil prices have corrected quite significantly from the top, almost 3% from the top has what the correction has been like. Now, coming to the Indian markets, you know, Friday's close was quite interesting, given the fact that after 2 consecutive sessions of significant selling pressure, Indian markets continue to bounce back in significant fashion. In fact, the pharma pack was the one that was the key standout performer, and whether that outperformance can continue is something that is going to be important to watch. The metal pack too was strong. However, the IT pack or the Nifty IT index was one of the top brags. Now today, you know, a lot of important events. Number one, you know, the listing of the second largest sports player in India, JSW Infra, that will be keenly watched. Apart from that, you know, all of the auto stocks after the monthly updates, you know, you'll have to see the reaction over there. And banks too, you know, quite a few banks have gone ahead and reported their monthly, quarterly updates. So that will be another interesting pack to keep an eye out for. Asian markets and Gift Nifty, like you mentioned, indicating a subdued start for our own markets.
All right, Vivek, thanks a lot for running us through all of those cues. Let me also toss it over to Nigel now, who's looking at all of the cues from the futures and options space. Nigel, coming out of a long weekend, how are things looking?
Well, the weekend was very good, right? And good to have you back, Pavitra. But we had a good start, actually, to the October series. On Friday, the markets looked quite good. And there was a bout of short covering that did take place because you had the Nifty as well as the Nifty Bank higher. And the open interest on both those two were lower by around 3 to around 4.5% odd. What did the FIs do, though? They continued to add some short positions. So they added close to around 4,000 short contracts, and they unwound some long positions, which takes the short positioning now to around 72%. That's the highest I've seen all the way since April itself. On the index option side, well, they bought 1 lakh calls, and it was in the ratio of more calls in comparison to puts. And on the writing side, well, it is pretty much even Stevens, with few more puts getting written in comparison to the number of calls that were written. Which brings us to the levels. Remember, in Friday's trading session, things really looked good. But if you pull up an intraday chart, you'll see that we went closer to around the 20 DMA, and from there we did see some bit of selling. So the 20 DMA becomes a line in the sand. The bears will be feeling confident they can defend this 19,750 to around 19,800. Just take a look at that. Intraday chart is what we saw. The recent low, that's on the 28th of September, which was expiry day. We went down to around 19,500. That becomes a crucial support zone. The Gift Nifty suggesting we pull back close to around 100 points or thereabouts. It will be an interesting trading session. For the time being, I think we continue to trade in that range of 19,500 to around 19,750.
All right, Nigel, thanks a lot for getting us all of those cues. That is where the implied open is at right now, currently 130 points in the red. Let me also bring in Surbhi now. She's looking at the entire list of stocks that you should watch for in today's trading session. Surbhi, the big news clearly coming through from Vedanta.
You're absolutely right. So the first one on our radar is going to be Vedanta. They've announced the demerger of its diversified business. So 1 share of Vedanta Limited shareholders will receive 1 share of 5 newly listed companies. Next is some banking stocks. They've come up with a Q2 business update. IndusInd Bank, the CD ratio is at a 12-quarter high and a CASA ratio is at 25-quarter low. The deposits are up 14% on a year-on-year basis. Federal Bank, the CASA ratio is at a 14-quarter low and the deposits are up 23% on a year-on-year basis. Karur Vysya Bank, the strong loan growth, the CD ratio has also improved and the deposits are up 13% on a year-on-year basis. Apart from that, auto companies will also be on our radar on the back of September sales numbers. Maruti saw a low single-digit growth and total sales were up 3% at 1.8 lakh units. M&M, it was a mixed bag, very strong SUV sales. However, tractor shows weakness. Total auto sales were up 17%. Hero Motor, the total sales were up 3.2%. TVS Motors, the sales were higher than the Nomura estimates. The total sales were up 6% at 4.02 lakh units. And lastly, Bharti Airtel will also be on our radar. The company has announced that it has over 50 million unique 5G subscribers. The total subscriber base is now at 338 as of Q1 of FY24.
Okay, that is a long list of stocks. Surabhi, thanks a lot for filling us in with all of that action. With that, it is time for a short break. But as Surabhi was just mentioning, Vedanta has undertaken a big restructuring exercise. So we're going to get into a break. But when we come back, we'll talk all about this and bring you the details with Nigel. Welcome back. You're still tuned into Power Breakfast. Now, the big news that came through over the weekend, Vedanta has announced a big restructuring where they're going to split into 6 different companies. The management has also said that a demerger will help them simplify their corporate structure and give investors the choice of commodity that they want to invest into. So Nigel is here with all of the details on this important story. Nigel.
Well, we'll have many more Vedanta listed entities and investors will be hoping that more is actually merrier. Well, in the past decade, they have merged entities and they have flirted with the idea of having different listed entities in November 2021. But at that point in time, they didn't go through with the plan. However, this time around, they've announced that shareholders of Vedanta Limited will get shares in 5 newly listed entities with focus on their core competencies. Vedanta Limited will hold 65% stake in Hindustan Zinc. Its upcoming semiconductor as well as display businesses and all the stainless steel assets as well will be housed under this name. Next up is Vedanta Aluminium. That will house the aluminium business, including the 51% stake they have in Balco. Vedanta Oil and Gas will have Kane India, while its copper and its zinc international businesses will be under Vedanta Base Metals. Vedanta Steel and Ferrous Materials, well, they'll have its domestic iron ore business, the Liberia assets, as well as ESL Steel Limited. And finally, all the power assets will come under Vedanta Power. Now, just break up their FY23 EBITDA. Bulk of it came in from Hindustan Zinc, which will be housed under Vedanta Limited, followed by the oil and gas as well as the aluminium businesses. The management says that the demerger will simplify their corporate structure. It gives investors the choice of commodities they want to invest in and also provides a platform for individual units to pursue their strategic agendas. You need to keep in mind, though, when they merged these entities earlier, they had given a similar rationale. Well, the demerger will require approvals coming in from the board, from the stock exchanges as well as the NCLT, and it's expected to be completed between 12 to around 15 months. The Vedanta Group, well, they get flexibility to unlock value for investors by liquidating any particular asset or bringing in a strategic investor. Well, in the current structure, there would be double taxation, as they would be paying profit on the sale of the asset and also on dividend payout. While on demerger, promoters will be paying only the long-term capital gains. The problem for Vedanta, though, is Vedanta Resources. The debt issue continues to remain unresolved, and they have payments of more than $4 billion from now till FY25. The promoter entity, Vedanta Resources, well, they have 3 tools to pay their debt. One is the dividend that they get from Hindustan Zinc and Vedanta Limited, money that comes in from the stake sale in Vedanta Limited, and also brand fees that they charge to the Indian listed entities. But now they are also running out of options. Hindustan Zinc's cash balance has been exhausted. Interest rates have increased amid downgrades by credit rating agencies. Now, post increasing their stake in Vedanta by 20%, Vedanta Resources, in fact, has sold some part of their stake, and that's made the street a little bit more nervous. On brokerages, Investec, they have a sell rating. They have highlighted that the company has carbon-heavy assets, and they're skeptical on the cash burn in the new ventures. CLSA, they have upgraded the stock from underperform to outperform, but they have lowered their target price to around 230 rupees, as they believe for sustained re-rating, the focus needs to be shifting back to the operating improvements. So short point, it's a good move. It's a temporary fix as of now. The stock opens up in the green, but we'll have to see whether or not there is some selling from the top.
All right, Nigel, thanks a lot for getting us all of those details on Vedanta and the restructuring exercise that they're about to undertake. But with that, it is time for a short break. On the other side, we're going to focus on all of the key macro data that came through over this weekend. Stay tuned for that. Hey guys, welcome back. You're still tuned into Power Breakfast here on CNBC TV 18. And let's talk about some important macro data that came through. India's core sector growth for August came in at a 14-month high, so it was at 12.1%, while the August tax data also showed strong growth. Lata is here with the editor's take on how she's really reading these numbers. Lata, good from both of these?
Well, gross tax revenues April to August has grown 15.1% to almost 12 lakh crore. And the split is very good. If you look at the direct taxes, they've grown by 26.6%. And within that, whereas indirect taxes have grown by only 7.8%, which is always good, because direct taxes fall more heavily on the rich. They should grow faster. Indirect taxes have grown more slowly because of the fuel excise cut. But within direct tax, income tax is up 36% year on year. And corporate taxes are up 15.1% year on year. Now, what is good about this number is that they're growing faster than nominal GDP, which means, what you call higher tax buoyancy. For 1 unit rise in GDP, there's a 1.1 rise in taxes, which clearly shows higher tax buoyancy, better tax collection. Now, GST is bringing more people into the tax net, and those guys are now paying income tax. So GST is not just an indirect tax reform. Looks like it is also giving us more direct taxes. And just by way of comparison, the April-July growth was only 2.8, and that had everyone worried that will there be fiscal slippage. Looks like there was a reconciliation problem. At 16% year-on-year growth, we are, there is no question because the budget estimate was only 10%. We're doing very well at 16% growth in the first 5 months. Core sectors very quickly, at double-digit growth is always good. And this double-digit is not coming on some negative number. Year ago, August was about 4.8. So it's a fairly decent base. On that, 12.1 is excellent. Best performing sectors, no prices for guessing cement. Remember all those cement price increases? It looks like when it's demand-led. 18.9% growth in cement. Coal, 17.9. That was expected because there was more power generation requirement. Electricity, 14.9. Look at the double digit and how. Steel, 10.9. Natural gas, 10%. Refineries, 9.5% growth. Only fertilizers and crude oil didn't do too well. But I think this double digit growth, infrastructure is excellent for the economy and, of course, for the stock markets.
All right, Lata, thanks a lot for getting us all of that important data that came through. By the way, with that, we are also going to wind down on this edition of Power Breakfast, but the Asian markets are still seeing pretty steep cuts right now. So the Hong Kong market is now down 3%. That's on your screen over there, almost 3%. The Taiwanese index down around 0.2%, and the Nikkei market's down 1.4%. The GIFT Nifty, like we've been pointing out, is indicating a big gap down at the open. So it is currently down 135 points on the GIFT Nifty. Thanks a lot for tuning in. We have Bazaar Morning Call after this short break to take all of the action forward.